work hard to save and build a secure retirement plan. Unfortunately, though, you don't own all of your retirement plan, as you have a silent partner, and his name is Uncle Sam. So how much of your retirement plan is yours? Find out right now. Well, hello, everyone. Thank you for joining us, and welcome to another edition of the Wealth Guardians radio show, where we tell you what you need to hear, not what you want to hear. I'm your host this week, Bryce Payne. Doug is out enjoying family and friends in for the holidays, but we appreciate you spending some of your holiday weekend time with us today before the games start. JB's joining me in the studio. Hey, JB, how are you doing?
I'm doing great, and happy Thanksgiving to everyone out there. I hope you've had a wonderful holiday, and I hope that you're enjoying it right now with your family.
Can we officially say happy holiday season now?
I think we officially can now.
All right, very good. Well, folks, before we get started, just wanted to take a moment on this Thanksgiving weekend to extend our thanks and gratitude toward all the men and women of our armed forces for your service, especially to those of you who do not have the benefit of being with your families this holiday weekend and holiday season. You are in our thoughts. Thank you. Mm-hmm. Okay, well, again, welcome to the show today. JB and I look forward to spending the next 30 minutes with you and giving you some solid financial information that hopefully will help you and make a difference in your retirement and estate planning.
And we would like to say once again, hello and welcome to the show today. You know, we know you work hard to save as much as possible to build for a comfortable, secure retirement plan. However, do you realize that you have a silent partner in your retirement plan? You may not know this, but his name is Uncle Sam, and he owns a portion of your retirement plan. Now, this is a surprise to many people, and it can really have a dramatic effect on a person's retirement plan. How can this be, Bryce? I mean, how much of your retirement plan is actually yours?
Well, JB, it certainly can be a problem, as most people don't consider the tax impact in retirement. When you're planning for retirement, it's fun to contemplate all the traveling, rounds of golf, restaurant meals, and other fun things you have ahead of you because, I mean, that's what retirement's meant to be.
Right.
You worked hard to get to this point, and you deserve all of it. Unfortunately, not everything you saved and feel you earned is actually yours. Many retirees discover, and they discover it too late, that their nest egg may be curtailed by 10%, 20%, 30%, or more, which is the cumulative impact of federal and state taxes on withdrawals from their nest eggs. The fact is that most forms of retirement income, including your Social Security benefits as well as withdrawals from your 401ks and your traditional IRAs, those are taxed by Uncle Sam. And unless you live in one of those 7 states with no state income taxes, you can expect your home state to ding you in retirement as well. This can have a serious impact if you do not understand this and you don't plan properly. If you don't understand how different types of retirement assets and incomes are treated tax-wise in retirement, then this can be a very serious problem and be a surprising tax bite and retirement to your nest egg. So that is what we're going to discuss today. Specifically, we're going to talk about all the different types of retirement assets and incomes and explain how each one is treated tax-wise. This way, you'll know how to be able to plan properly, hopefully minimizing this tax effect. If you do understand this and plan properly, then the good news is there are ways and tools to minimize these taxes and cause your silent partner, Uncle Sam, to be a much smaller partner or possibly even be able to get rid of him altogether. So let's get started today, JP. What's the first item?
All right, Bryce. Well, let's start with the main assets in retirement for most people, which are retirement savings account, like the traditional IRAs, 401ks, 403bs, SEP IRAs, etc. What is the tax burden on these, Bryce?
Well, unfortunately, many people forget these plans are fully taxable in retirement. Remember, these plans, you got a tax deduction on your contributions when you put your money into them. Mm-hmm. This is where you brought Uncle Sam in to be a big partner in your retirement plan. You invited him in when you contributed money into these plans as you took the tax deduction up front, which means you have to pay taxes on that money upon withdrawal. Plus, you have to pay taxes on all the interest that money made over your working years. Again, many people don't realize this up front, or they simply forgot it. So the key question is, how much of these accounts do you actually own? Now, there really is no set answer to that question. Basically, what you own depends upon what tax rates are when you take the money out. Again, Uncle Sam is in control of this. If tax rates rise in the future, then he gets a bigger portion of your retirement plan when you start taking the money out. So no one knows exactly for sure how much of their pre-tax retirement accounts they own because it all depends on what the tax rate is when they decide to withdraw it. Now, don't feel you can get out of paying tax on this money by not withdrawing it because Uncle Sam will not allow you to do that. Once you reach the age of 70 and a half, every year from that point on, you have to take out a certain portion through what is called a required minimum distribution. and pay tax on that money at that time. So you can't just forget about the money and let it grow forever, because Uncle Sam's not going to let you do that one. In addition, if you do end up passing away before you've used up all the money in your pre-tax retirement accounts, well, guess what? Your heirs will have to pay taxes on the money at that point, and it'll be taxed at whatever tax rate they are at. So there is no way around this, folks. You do have a partner with your pre-tax retirement plan, and his name is Uncle Sam. And you need to make sure you understand this, because, again, it will cost you taxes to get this money out. Now, another thing, this is not the only issue here, and there is another big effect of this, which is the main culprit for causing another retirement asset to be taxed.
Bryce, I believe you may be talking about Social Security here.
You're smarter than you look, JB.
Thank you.
Social Security is a part of almost everyone's retirement plan. And again, many people don't understand that in some cases, Social Security income can be taxable, at least a portion of it can be. This upsets many people because they pay into Social Security system during their working years, and they feel it is just unfair to have to pay taxes on their own money when they get it back. But that is the way it is for some people. Now, once upon a time, Social Security benefits were actually tax-free, but that all ended with the signing of the Social Security amendments in 1983. Currently, depending on what is called your provisional income, up to 85% of your Social Security benefits are subject to federal income tax.
Bryce, let me stop you right there. What is actually provisional income?
Yeah, that's a good question. Provisional income is a formula that you have to figure out and complete. It's a whole separate tax form that you have to complete when you turn Social Security on to determine whether or not you have to pay tax on those benefits or not. So to determine your provisional income, you take your modified adjusted gross income, which is basically all of your incomes, retirement savings plan withdrawals, and interest on assets in retirement, except for a couple of specific tax-free incomes. Then you add in half of your Social Security benefits. This comes up with a total figure, which is called provisional income. So if your provisional income, we're going to go over some numbers now.
Okay.
If your provisional income is less than $32,000 for married filing jointly or $25,000 for single filers, there's no tax on your Social Security benefits. So that's the good news.
Okay.
However, if you have provisional income between $32,000 and $44,000 for married filing jointly, or $25,000 to $34,000 for single filers, then up to 50% of your Social Security benefits are going to be taxed. And now get this.
Okay.
If your provisional income is more than $44,000 for married filing jointly or $34,000 for singles, then up to 85% of your Social Security benefits are taxable.
Wow.
Yeah. So as you can see, it does not take much income to cause your Social Security benefits to be taxed, especially when you consider the RMD requirement on your retirement savings accounts. So the way the system is set up, not only is Uncle Sam a partner on your retirement savings plan, most of the time he becomes a partner in your Social Security income as well.
Well, Bryce, let me ask you, is pension income taxable, and is it countable in the provisional income formula?
Another great question. Yeah, unfortunately it is, because the way the tax system is set up, if you receive a pension, not only is the pension federally income taxable and likely state income taxable as well, but it generally causes a good portion of your Social Security benefits to be taxable on top of that. Again, this is just how the tax code is set up. Don't blame me. Pension income is countable in the Social Security income tax formula. So again, that is another reason it can have a multiple effect, causing a lot more of your assets and incomes to be taxed than you would have ever expected.
Well, let me ask you this. What about rental income, Bryce?
Yeah, we get a lot of those people who are those landlords in retirement.
Right.
And taxable and countable in the Social Security provisional income formula as well. If your rental income exceeds your rental expenses for maintaining the property, then that is income and it is taxed at ordinary tax rates.
Wow. Well, what about interest from bank accounts and dividend interest?
Bingo. Taxable and, again, countable in the Social Security provisional income formula. Now, dividends are a little bit complex. Dividends are the profits gained from stocks and mutual funds. There are two types of dividends, qualified and non-qualified, and they are taxed at different rates. Qualified dividends, which are the most common type that investors typically encounter, are taxed at what's called long-term capital gain rates. Now, long-term capital gain rates can be either 0%, 15%, or 20%, depending on how much income you have. Non-qualified dividends are taxed at your ordinary income tax rate, which can be higher than the capital gains rate. So to be considered as qualified, dividends must be held, and I love this formula here, dividends must be held for a minimum of 60 days during a 120-day period, which begins 60 days previous to the ex-dividend date. The ex-dividend date is the day after a company distributes dividend payments to its shareholders. That's all very complicated, but note that if the dividends stem from a tax-deferred account funded with pre-tax dollars, like your 401k or IRA, and the dividends are reinvested, then they aren't subject to taxes at that time. But when you start making withdrawals, they will be taxed at your ordinary income tax rate then.
Well, let me ask you about municipal bond interest. This is supposed to be tax-free, so surely it is, isn't it?
Oh, of course not, JB.
Oh, man.
Not completely tax-free anyway. The interest on a municipal bond is not taxed at the federal level, so there you go. But capital gains from the sale of these bonds can be taxed. Plus, bonds not issued in an investor's home state are taxable in that state, so a lot of times it's subject to some tax. And in addition, guess what, JB?
What?
Even though the interest is federally tax-free, it still gets counted in the provisional income tax formula for Social Security taxation.
Really? Now, that really does not seem too fair after people work so hard.
Well, JB, the IRS tax codes are nothing if not fair, right?
Right.
I mean, that's why it is so important to know and understand all of this before you retire, so you can plan properly to minimize these tax issues and try to make Uncle Sam less of a partner when you retire.
So, Bryce, there are ways around some of these tax issues in retirement, correct?
Yeah, there actually are some ways around this to be able to minimize the partnership you will have with Uncle Sam in retirement, or maybe even be able to eliminate them altogether. And we'll be getting into that in the second part of the show today. We're going to share with you some ways to reduce this tax burden and hopefully share with you some potential solutions.
Well, I look forward to hearing all about that. Remember, folks, you're listening to the Wealth Guardians radio show right here on 94.5 WPTI. We appreciate you being with us. You can reach us at 336-391-3409 or visit the website at thewealthguardians.com. We're up against a quick break, but stay tuned. We've got several more retirement assets and incomes to explain how they are treated tax-wise and, of course, find out how to reduce or eliminate some or all of these taxes. Stay with us. We'll be right back.
All I know is that I fell in love with you.
And welcome back to the Wealth Guardians radio show, where we tell you what you need to hear, not what you want to hear. Right in the middle of our very important show explaining the tax bite in retirement and how different types of retirement incomes and assets are treated tax-wise. So, let's continue. You know, Bryce, another very popular retirement asset is annuities. Now, I know there are different types of annuities, but how are they treated tax-wise?
Yeah, very true, JB. Annuities are a big retirement asset because many people own them, and there's a good chance that some or all of the income you receive from any annuity you own is taxable. Annuities are either classified as a qualified annuity or a non-qualified annuity. Qualified annuities are like IRAs. They're funded with pre-tax dollars and are fully taxable upon withdrawal at ordinary income tax rates. In fact, an annuity can be in an IRA. Many people choose to use IRA money to fund an annuity. Now, a non-qualified annuity is funded with after-tax dollars. In this case, the portion of the payment that represents your principal is going to be tax-free upon withdrawal. The part that represents the interest is taxable. So, for example, let's say you purchased an annuity with after-tax dollars using $100,000 of money from your savings account. And let's say in 10 years, it's worth $190,000. In this case, you would only pay tax on the $90,000 of interest that was earned. Your original $100,000 is your basis and not taxed when it comes out. But one thing you have to understand about non-qualified annuities is they are considered what's called a LIFO contract. LIFO stands for last in, first out, LIFO. Mm-hmm. So the way Uncle Sam sets the tax code up is that he requires that all money coming out of that annuity contract is the interest portion first. So in this case, when it was worth $190,000, the first $90,000 you take out will be considered to be the taxable portion. So he makes you pay taxes on all the interest portion first before you get into your principal, which is not taxed. And guess what, JB?
What?
The $90,000 interest is countable in the Social Security income formula which determines how much of your Social Security is taxed.
Well, of course it is. Okay. Now, another common retirement asset is the investments like stocks, bonds, mutual funds. How are they treated tax-wise in retirement, Bryce?
Well, again, if they are held in an IRA or company-sponsored retirement savings plan like your 401k, then they are fully taxable at ordinary income tax rates upon withdrawal. But for after-tax brokerage accounts that contain stocks, bonds, and mutual funds, if the sale of these have been held for more than a year, they are taxed at long-term capital gain rates, which again can either be 15%, 20%, or maybe not taxed at all, depending on your other incomes. If they're short-term capital gains, then basically they're taxed at ordinary income tax rates.
Okay, well, this is kind of getting old, kind of like a broken record. It seems everything is taxable in retirement. Are there any types of assets and incomes that are tax favorable or even tax-free in retirement, Brian?
Yeah, well, the good news is yes, JB, there are. Let's turn the mood of this show to something slightly positive, shall we?
Great, that's great.
Okay. Probably the most popular asset is a Roth IRA. Roth IRA money can be completely tax-free. Unlike their 401k and traditional IRA cousins, which are funded with pre-tax dollars, Roth IRA money is funded with after-tax dollars. You pay the taxes on your contributions to Roths right up front. By doing it this way, your withdrawals are completely tax-free. Now, in order to be completely tax-free, you must leave the money in your account for at least 5 years before you can take completely tax-free withdrawals. For Roth IRA contributions, the contribution part, you can actually withdraw the amount you contribute at any time tax-free, but you must be at least age 59 and a half and have held the account at least 5 years in order to be able to withdraw the gains tax-free and without facing a 10% early withdrawal penalty. So there's a big difference between your traditional IRAs, 401ks, and your Roth IRAs and Roth 401ks. Again, traditional IRAs and 401ks are tax-deferred going in, meaning you save taxes up front, but you pay those taxes and possibly many other types of taxes upon withdrawal. Roth IRAs are the opposite. You don't get the tax deduction up front, but you get to take the money back, including all the interest it makes, completely tax-free in retirement. So here's an easier way to look at it. A common analogy to explain the difference is that with a traditional IRA, you do not pay tax on the seed when you plant that crop. But when the crop comes in, the entire harvest is taxable. With the Roth IRA strategy, you do pay tax on the seed when you purchase it, but the good news is that when the harvest comes in, the whole harvest is tax-free. So that's one way to think about this in an easier way. The key question is, how do you know which one to use? Well, again, this will be different for everyone out there. You have to determine what is best for your own individual situation. So if you're in a very high tax bracket today, and you're making a lot of money and you feel you'll be in a lower tax bracket in retirement, then you should probably be funding your retirement accounts on a tax-free basis. Take the tax deduction today while you're in a higher tax bracket and then pay taxes on your money later when you draw it out and when you're in a lower tax bracket. That's the ideal situation to fund with a pre-taxed account. However, if you're not in a very high tax bracket today and or you feel you're going to be in the same tax bracket or maybe even a higher one when you retire, then you want to fund it on the Roth side. You do not want to take the tax deduction up front. Go ahead and pay taxes today while you're at a lower rate so you don't have to worry about paying taxes on it down the line, especially if taxes rates are going to be higher, as they most likely are.
Right.
So if you're like me and you truly feel that those tax rates in the future will be a lot higher than they are today, which I firmly do, then you have to be very careful about funding things on a pre-tax basis because you'll be taking a chance down the road that tax rates will be much higher. If you look at the history of the tax code in our country, you will notice that almost all years prior to the new tax code, the tax rates were a lot higher than they are today. Basically, tax rates today are at an all-time historic low. So there's a good chance with everything going on with our national debt and spending issues that tax rates will have to go higher down the road. If that's the case, you have to be very careful about funding things on a pre-tax basis. So you just have to figure out the best way for you to save for retirement. Now, as we've said 100 times before, maybe 101 on this show, saving for retirement is very important, but how you save is much more important. So you just have to figure out the best way to save in order to pay the least amount of taxes as possible going forward in your own individual situation. Now, another major tax benefit, and the good news about Roth IRA withdrawals that you probably aren't aware of, is that they do not count in the formula which causes your Social Security to be taxed. So all the withdrawals are not only tax-free, but they also don't count in the provisional income formula, which could possibly help your Social Security not be taxed as well.
That's some great information there, Bryce. Well, tell me, Bryce, are there any other tax-free assets?
Yeah, there is one more truly tax-free asset, and that is life insurance. Now, most people know that life insurance proceeds paid to a beneficiary because of the insured person's death are not taxable. That's a great benefit and is why life insurance is a great asset to leave as a legacy. However, one of the best benefits that many people don't know about life insurance is that the cash value withdrawn from a life insurance policy during the insured's life can be tax-free as well. This is why it is another retirement savings tool that is used by a lot of very smart people when planning for their retirement. They utilize this asset as well as a Roth because sometimes you cannot get a lot of money into a Roth IRA, and life insurance can help you get a lot more money into a tax-free position.
Well, Bryce, we're almost out of time.
Oh, no.
I know, but before we do go, please explain, if you can, what you mentioned in the first part of the show today about how to get around many of those tax issues in retirement and minimize the effect that taxes can have on your retirement plan.
All right. Well, the key in doing this is to use all the different types of retirement savings tools properly. You want to save properly for retirement and save in the right types of accounts. In fact, you want to try to use as many different types of accounts as you can in order to take advantage of the benefits of each, but not have too much into all the different types when you can get into the disadvantages of each type. Remember, every type of retirement savings tool has its advantages as well as disadvantages. You want to use each tool to your benefit. Basically, what you want to do is have your different buckets balanced properly at retirement in order to be able to draw from each of those buckets strategically. And that's the key word here, strategically, to be able to take advantage of how the tax code is written at that time in order to get the retirement income you need with minimal tax consequences. So to give you an example, even though pre-tax retirement accounts can be a problem in the future, as we've talked about today, there are still times where it makes sense to have some money in a pre-tax retirement account. Basically, there is a certain amount that you can draw out where it won't cause your Social Security to be taxed, and then also have the standard deduction eat up that amount of money so that it's parted and not taxable. And then the key is that you draw the rest of the income you need from some of your tax-free accounts so it doesn't cause any of those other two to be taxed. So in a lot of cases with our clients over time, we get them to become very tax efficient. And hopefully at some point in their retirement years, we hope they will not have to pay any taxes at all, including the money they saved on a pre-tax basis. That's the absolute best situation. If this is something you have questions about, folks, please feel free to reach out to us because we would be very happy to help you understand all this and help you to be able to properly save for retirement the best way for your specific situation. If you'd like more information about all this that we discussed on the show today, feel free to give us a call. That's 336-391-3409 or visit our website at www.thewealthguardians.com. We appreciate you joining us today, and hopefully this information was helpful in getting you as tax efficient as possible in retirement and in reducing the effect your partner, good old Uncle Sam, is going to have on you in retirement. We look forward to coming back to you next week. Until then, enjoy the rest of your holiday weekend, folks.
And once again, if you want more information, feel free to give them a call, 336-391-3409, 336-391-3409, or check them out online at thewealthguardians.com. Great show, Bryce. Have a great weekend.
JB,
we'll
pleasure. You too.
The information provided is for educational purposes only and not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Wealth Guardians and do not necessarily represent the views of the Alpha Star Capital Management. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Any comments regarding safe and secure investments and guaranteed income refer only to fixed indexed insurance products offered by Wealth Guardians. They do not refer in any way to securities or investment advisory products. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, a registered investment advisor. AlphaStar and Wealth Guardians are independent entities.